The lowest rated junk bonds have rallied the most recently. And even though you've got stocks possibly selling off, credit markets have shrugged off all concerns about rising inflation expectations and higher rates. Investors have even thrown money at companies such as WeWork, which has burned through cash and has an unproven business model. Are investors being too complacent? Still with us are Jason Sabatky of Yacktman Asset Management and Mark Okada of Highland Capital. Mark, I want to start with you. I want to look at a chart showing the pretty dramatic outperformance of CCC rated corporate debt. You can see this is the blue line in its normalized returns since the end of October 2017, outperforming both the broader high yield index as well as higher rated high yield bonds. What does this say to you about risk tolerance, and are investors being overly complacent here?
A lot of that is energy. There's a lot of energy in that space. We've seen oil have a bid to it, so that's had good tone as far as risk taking. But again, it's all about supply and demand, and we don't have a whole lot of supply on the CCC side in the high yield.
Were you buying WeWork?
No, we didn't buy WeWork. But the success of that issue tells you the story right there. The supply demand within high yield has been really good. We've had nice technicals, and so when you come with a deal that's got a lot of equity value to it, right? A lot of support from that standpoint. People will find a way to own that because that's a big coupon in this market, and so there is a demand for that because there hasn't been a whole lot of issuance in the high yield space, in the loan space, and so the technicals have been really good there. It's just the opposite in high grade. Right, and that market has had the worst start in the last 20 years. It's down 3.4% in the first quarter. That's an awful start to higher quality credit across, and it's really about technicals.